So as we all know, budgetary policy is usually considered an aggregate demand management policy. But in some cases, budgetary policy can help improve aggregate supply side conditions. Now this video we're going to focus on how promoting national savings through the budget, either through conducting budget surpluses and discretionary stabilizers, discretionary policies, can help improve national savings, and so as a result improve aggregate supply. Okay, so we're going to, like with every aggregate supply lecture, break down aggregate supply. So aggregate supply is a component of primary factors as well as secondary factors. And now primary factors include land, labour and capital, and our secondary factors include efficiency, or the rate of efficiency that we use our primary resources. Now of course, as we know, aggregate supply, or in this case national savings, affects aggregate supply through this aggregate or this capital investment component. So we're going to focus on how national savings can help increase capital investment or investment in technology. So first we're going to look at this through a budget surplus perspective. Okay, so now we know budget surplus, or B, budget surplus occurs when revenue through taxation exceeds expenses of the government. And so as a result, if we go back to the lecture on budget surpluses, they can use this to store it in a national savings pool. So the excess in revenue to expenses is stored in national savings pools, or the national savings pools. So what they do with the national savings is that this gives the opportunity for private businesses to actually invest in capital. And so firstly, this would raise investment capital because it creates what we know as a crowding in effect. So we exclusively talked about the crowding in effect as being an effect that moderates or increases aggregate demand, even though budgetary policy is trying to, in cases of budget surpluses, is trying to slow down aggregate demand. And so this is contradictory to the aggregate demand management side of budgetary policy. However, it does help in some cases build national or increase national investment. And so why this is the case is because investments in a lot of cases are costly. And in most cases, businesses don't have the money to directly invest. So take a look at an example of a firm wanting to build another high-rise tower. It's not cheap. It's not $1 million to build a tower. It's usually a couple $100 million, and firms don't have the money to actually buy outright a tower or a plane or a machine or whatever capital resource they wish to have. So as a result, what they do is, to account for this cost, they borrow money. And when they borrow money, they can repay the money in increments throughout a number of years, so that they can spend now and pay later. And that's the basis of how these financial markets operate, is this idea of having money now and paying back later. And so with a national savings pool, this actually eases inflationary pressures or interest rate increases in interest rates. So what this suggests is when the supply of money increases, so we have R being the real interest rate and Q being the quantity of money, when the savings pool actually increases from, say, S1 to S2, we can see as a result the demand for money, or the interest rates, have decreased from R1 to R2. So this decreases for businesses the cost of borrowing, and therefore results in an increase in investments. The crowding in effect would actually increase investments, and as a result, that would improve both capital and capital efficiency for firms. Secondly, the budget can use discretionary stabilizers in order to promote national savings. So instead of just conducting budget surpluses or implementing a contractionary budgetary policy stance by the government, they could use discretionary stabilizers in order to increase the national savings ratio. And as we've talked about, major discretionary stabilizers to increase household savings include the superannuation guarantee charge. So this is a policy where they slowly are trying to encourage business superannuation payments from 9% of wages to around 12%. And they're trying to achieve this by 2019 to 2020. Another discretionary stabilizer that we talked about in our video on how budgetary policy can increase national savings is this idea of generous tax advantages for actually contributing to your super by yourself. And so what this is that the marginal, or that if they increases in superannuation, so if workers actually contribute to the superannuation themselves, it becomes tax deductible. And also, if workers don't actually touch their super until they're around 65, then they can take out all their super free of tax. So that's how the government actually uses discretionary stabilizers in order to increase national savings. So the superannuation guarantee charge, tax advantages, all help to incentivize people to increase national savings, and as a result, encourage business spending on capital, which increases the efficiency or the technology or the use of technology by current businesses. So as a result, we can see that aggregate supply will increase as investment expenditure increases. So that's how national savings as part of budgetary policy can help improve aggregate supply in our economy.